Good morning. It is Monday, September 16th, and we've got an interesting week ahead. This month has been interesting with stocks really going down severely the first week, but then the stock market bouncing right back. It was a pretty incredible week. Um, what I wanted to do is kind of go over the market, and there's a few expectations I have of the week that I'll share with you. Kind of set up, how I'm going to go approach the market this week and what I plan to do. And I'll share that with you. And it looks like I've got few people on providing some comments. So it looks like um, out of the gate, Alta wants to discuss KSS. Glad to do so. And we talk about discretionary stocks. And then Sebastian, have I ever considered African stocks? Zenith Bank, never. But I can take a look and see what it's all about. Always open to learning something new. I just weigh my decisions carefully as I go outside the U.S., my home country. It's the place where I know, like, hey, I know the companies, I know the economy. But I wouldn't be opposed if it's an opportunity to learn something. I'm all for it. And then best of, thanks for joining. So let me go over just a little economic information, and then we could dive into some of those stocks that people want to see. So first, the markets are set to open, I'm going to say, relatively flat. Oil prices are a little higher. Let me make this bigger. So oil prices are higher. That's a good move. We've been talking about oil stocks quite a bit on the live streams, and it's a good idea. Buy companies when they're priced low, especially if they're affected by a commodity like oil. Then when oil bounces back, those stocks are going to bounce up. So all the talk around oil stocks, it's been pretty productive. I think each live stream over the last week or two, we've talked about oil stocks. Not a bad idea. If we see that oil price continue to go up, that means oil stocks continue to go up. I would say they're still discounted because the move on oil has been pretty dramatic. If we look at the 1 year, oil prices have really gone down, right? And that really takes down oil stocks. But if you have that oil price bounce back to $80 a barrel, which is kind of a normal level, if you look at the last 3 years, oil stocks are going to do quite well. That's a pretty solid 20-30% return. It is the morning hours of my day here in California. And if you don't mind, I'm going to enjoy a cup of coffee while we talk about stocks. So the whole talk around, oil stocks, I think it's productive. Keep at it. I have Chevron. I have over $100,000 invested in Chevron. I'm good on Chevron. I'm also buying Pump, which is a small company that does services for companies that want to do fracking. And that is a method of getting oil in areas where the oil is trapped in sands and in the soil. They basically cause the oil to come out when it's difficult to extract it under traditional methods. So I like that company. It's a little company. They operate well. They keep growing, even though oil goes up and down. They tend to grow each year. So I like that little company. Not a lot invested in there, but it's a pretty good stock. So Sebastian wants to look at Schlumberger. We can add it to the list. We looked at Schlumberger, I'm going to say about a week ago, for sure, maybe 10 days ago. And we can look at it again, see what's going on with that stock. And I think Sebastian wanted to look at Zenith Bank. That's in Africa, right? So I'm not sure if I'm going to have access to it. But if I do not, I'll I'll have to punt on that one. All right. So oil prices are on the move. We'll see where stocks go. The biggest thing that's going to affect the stock market is going to be the Federal Reserve. So the Federal Reserve has certainly moved the market over the last 5 years. To begin with, you had in the COVID years, they had historic stimulus where we had money going to citizens of the US and people are getting checks. And that stimulation really drove a lot of stocks. I think we're going to talk about consumer discretionary. Man, those companies really flourished because people were flush with cash and they could go online and buy it from Amazon and buy stuff that is a discretionary purchase. Wonderful. Now, the other thing they were doing was they were helping companies, pay their payroll with basically money they didn't have to pay back. So some of these companies were quite profitable during that time. So they stimulated the economy and then they go, oops, inflation is super high at 9%. We got to raise interest rates to slow things down. So it's a little bit of hot water to cold water very quickly. And that increase of interest rates really made a big move in the market. And once it hit the high, right, like interest rates were at 9%, 10%. And that's on the secondary market for corporate, yields. They stopped and then they started to decline interest rates. And then it's been kind of a slow move downward for the last year and a half, 2 years. It made investing in bonds, it made investing in bonds 4 years ago just completely undesirable. Bonds were like totally undesirable 4 years ago. 2 years ago, they were incredibly desirable. And I bought into bonds knowing I could lock in 6, 7, 8, 9, 10% yields, depending on risk level. And risk level on bonds is far lower than stocks. But I would just say that I have some bonds producing over 10% yield. I have bonds producing that are super low risk, producing 6% yields. So it was the right time to do that. Now that interest rates are lower, those bond values have increased. So the Fed really moved the markets. Now they're beginning to kind of do some more finer adjustments now. If they move from 50 basis points, 25 basis points, that's kind of what's expected. That's the binary decision they're going to make. Now, if they go 25 basis points, the market might be like, wasn't enough. I don't know that it's going to move the market a whole lot. The market's probably going to be like, okay, whatever. Because the next day we have the employment data coming out. And that employment data is really important to me because unemployment has been going up, and unemployment tends to be a measure that goes up really fast. If we see a tick up in that unemployment report, which happens Thursday, then we're going to have a big sell-off. We will have the stock market really price in a recession. And so right now we're expecting initial jobless claims at 230,000 initial jobless claims. That came in at like 250. Look out. It's going to drop because it'll be clear we're heading into a recession. And recessions with joblessness are the ugliest ones. They're painful. People are out of work. It's the worst. So that actually, I think, could move the market more than the Fed. I watch business news, like I watch Bloomberg. It's on in the background here without sound, and I watch CNBC and so forth. And I have to turn it off because they talk about the Fed, the rate decision. I don't think they have anything else to talk about, so they talk about it over and over again. And I don't like to hear the same thing over and over again, so I shut it off. Pretty much put it on mute. I'd rather hear stories about, hey, this one company is doing something innovative. Okay, that's the kind of stuff that I want to see. That said, so if we go 25 basis points, I think market's going to be like, whatever. If they go 50, I think it's going to say two things. One, okay, interest rates are heading down, but it might be like a little bit of a tell that, yeah, we're heading into a recession. They wouldn't be cutting that quickly if they didn't feel like we had exposure to to a recession. I don't believe the recession is going to be that bad compared to historic recessions. I think it'll be uh, somewhat manageable, and we'll get through it in 2025, 2026, whenever it happens. So that's the news that's going to happen this week. How it affects trading today and tomorrow, and really the morning of Wednesday, I would be surprised if there was any heavy volumes. I think investors are going to kind of stay put until they get more information, and then the volumes will come in on Thursday and Friday. Now, one thing I wanted to just highlight, in addition to the big news that's coming, I get this email that comes in from I forgot which membership I'm a part of, but they bring up some interesting facts about the consumer. So the consumer represents 70% of the economy in the US. And what basically this report shares is a couple of data points that are concerning. The first one is that the number of delinquencies against credit card balances is 9.1%, which is higher than typical. And it's the highest rate in over a decade. Okay, that's a concern. Ally Financial, which we covered on a live stream last week, their stock dropped 18% because they came out and said, hey, the CFO said that the late payments and charge-offs on auto loans was much higher than expected in July and August. So that's showing that the consumer is under stress. And over the past year, roughly 8% of auto loans turned delinquent. Okay. So auto sales, if you recall, during the peak of inflation, car values just really went up. Used car prices, new car prices were through the roof. And now that's all beginning to really become a big burden on the consumer. So the consumer is beginning to get tired and start going delinquent on their loans. Well, that's going to, the financial sector is going to begin to feel that. Ally for sure felt it last week when their stock dropped 18%. But that's really going to get to other financial services companies, whether it be banks and others that are lending, that capital for it to be either revolving credit or a loan on a car and things of that type. And it really speaks to, car purchases. That's a good data point because it tells you, okay, that's a very big purchase in the typical consumer's life. But they're also probably struggling on other purchases they made. Maybe they bought a refrigerator and they bought it on a buy now, pay later program, or they, bought something else that they needed for their home or they wanted for their home. All those things, I think are measures. It makes me think that, this will be part of the story that leads me, or I should say, some of the facts that lead me to continue to think, okay, we're going to have a recession. We need to, similar to the way I feel the stock market, the prices keep going up, and you need a correction so that it could pull back some of those prices and bring them back closer to the intrinsic value and make them a more attractive investment versus, man, you got to really reach out and buy a stock at a high price and probably just have a low rate of return, which why would you buy it, right? I wouldn't buy it, but that's me. Same thing with the economy, right? Once it starts operating with too much exuberance, people are buying cars that are too expensive, getting into loans that are too much. That pullback causes auto manufacturers to lower their prices. It causes the lending policies to get a little tighter. That way they really lend to people who can pay back. All those things tighten up the economy, which is healthy. It's good. It's medicine. So I think the economy is going to have to tighten the belt a bit as we head into this slowdown / recession. So I thought that was interesting. I'll share it with you. And just to conclude, you know, I want to, I try to keep things simple. It's not about, looking at 100 different things and trying to arrive at a actionable, item. Um, what I would say is there's some things that would cause stocks to go up over the next 2 months, and there's some things that would cause stocks to come down. The things that I think could, really continue to make stocks go up is low interest rates. Hey, low interest rates help, especially small caps, because it just is a fact that with low interest rates, small caps flourish. Low inflation, that means companies have uh, have to pay less for services and goods that they're buying in order to operate their businesses, as well as the consumer will have more discretionary income because their food prices are lower, and then they can buy products from these companies. And then low oil prices. There's a lot of industries that depend on oil. Airlines, they major cost item to them is oil. So that should help them. Now, the things that can cause stock prices to drop, I'll lead off with the election. And we're roughly 2 months from the actual election day, and it's already pretty heavy on people's minds. And that's going to continue to get heavier as we head toward the election. And it's not a matter of who's going to win, who's going to lose, and which side and where taxes. It's just in general, it's just more that the investors are thinking about. I happen to think that stocks are expensive, that there's high PEs. I can show you historic data where PEs are high and earnings are declining. You hear Adobe came out and said, hey, fourth quarter is not going to be as good as we would like. You have Apple that's not growing. So you have data points that show that, hey, stocks are pretty expensive and earnings are not growing, revenue's not growing, and PEs are pretty high. So that could really weigh on it. Of course, there's recession worries combined with the election worries. Employment data, again, Thursday, the biggest report of the week for me is Thursday. If that employment data comes in worse than expected, it's going to be a pretty bloody sell-off. It's going to be pretty red on Thursday afternoon and on Friday, and it's going to establish the theme for the following week. If it comes in as expected or even more positive than expected, that's going to help stocks, keep their levels, maybe even rally a bit. So we'll see where that goes. And then last is September and October. It's kind of like the seasons change, right? It's fall colors begin to appear. The heat from the summer goes away and you have cooler temperatures. That's all a seasonal change. And for some reason, the stock market sells off on September, October months. And you can look at the data. Most of the time, September, October sell off. And this year, based on where we're at, I don't see that changing. I think we're going to sell off in September, October. There's more things that are pushing down stock prices versus setting it up for a really nice rise. So enough said. How does that affect my investing? Where do I go having just established, hey, okay, so that's what I think is going to happen. So what am I going to do about it? So as I look at my investments, I'm gonna slow down my buying. There's some stocks that I really want to own, most definitely, but it's only going to be a select number of stocks that I'm ready to, buy if there's any kind of pullback. The companies that I want to continue to accumulate, first one is Nike. I just want to build up a really big position of Nike. It's the number one player. You can see the individual video on my channel of why. That's one stock that I'm going to buy into no matter what. Amazon, I want to build a big position. I want to build it in Amazon. And I might have like, I might buy Amazon and then the value of my stock goes down. But I dollar cost average my investments. I could see investing $100,000 in Amazon, and it's going to take a while. I don't just, drop, big chunks of capital into a stock. I buy it over time. And last week I bought $6,000 of Amazon. The week before, forgot how much, but each week I could see myself buying into Amazon as well as Nike. Nike, I could see myself investing $50,000 to $75,000 into. The other, I think there was another stock that I wanted to buy. So there's just a few stocks that I'm green lighting to buy. Here we go. So Pump. And Pump's a small company, so I nibble on small stocks. I might buy a couple $100 at a time, $200, and just continue to build a position. I'm only at $1,200, but it's a tiny company. I don't like taking super high risk on tiny companies. I'll build it out over time, maybe invest $10,000 in that company over time. Those are the stocks that I'm like green light for the week. Those are the stocks I'm ready to buy. I want more information. I'm going to wait toward the end of the week and see what the Fed says and where the employment data is at. That'll kind of give me a view of what I think the sentiment's going to be in the market, and then I'll be able to take action. So one thing that, I've been asked about bonds quite a bit, and the investing long term, I'll make a point, which is it's when you invest for the long haul, it's hard to make a decision, buy something, and then watch it rise or fall over the next 3 months. But it's very clear over a 2-year horizon that a decision was a good one or a decision was a bad one. And I was loading up on bonds 2 years ago. I'm like, man, rates are super high. I can lock in these high yields. And now I'm benefiting from it. So it's one of those things where rather than, what's going to be good next week, next month, it's, sometime in your investing kind of decision making or planning, speaking for myself, I try to think 2 years ahead, like what's going to happen over the next 2 years? What are some of those trends that could happen? And when it was high interest rates, I thought, okay, interest rates are probably going to fall from here over the next couple of years. I don't know how fast, I don't know how quickly, but I locked in really good yields on my bonds. And now I'm sitting on really good yields on these bonds. Okay, great. But it's hard to buy bonds right now because as interest rates drop, the price of bonds go up. So you're paying a higher price. I think that the rate drops on bonds, the yields, are probably going past where they should, and they'll probably begin to rise. Now, as rates rise, the price of bonds drop. So I'm waiting for some of that action before I load up more on bonds. And the second reason why I'm not buying into bonds right now is that I want cash. I want cash because if we do have a correction in the stock market, I want that cash so I can buy into stocks once they correct and give me better prices. So that's a quick flyby. As I plan out my week, I try to have a sense of, what's going on with the market and then see how things go. So, all right. So that was kind of like my opening comments. I went a little extra long. Thought I could provide just a little more, thought process on the week. And let's get into some stocks. I'm going to kind of pick up where I left off, and I'm going to wait a little while to get to your comments. Just hang in there, keep commenting. I'll get to them, but I don't want to keep Alta waiting on C or KSS. So let's look at KSS. So KSS is Kohl's. Kohl's Corporation operates omni-channel retailer. So they're a retailer. And they're a good store. They have a lot of apparel. They also have home goods, like, stuff for your kitchen, things of that type. It's a nice store. Uh, my wife and I shop there. It's a good experience. It has a tiny market cap, and wow, look at this dividend, 10% dividend. Now, I don't like investing in retail, and retail is just one of those industries that is really undesirable to me, especially this type of retail, because you think about how challenging it is. You got to rent out, lease out, real estate is super expensive. You got to hire employees. You have goods that are available for people to browse through, and there's a lot of theft. Just a lot of forces that are really acting against you. You have a lot of competition, and the competition that's really hurting these companies is the new preferences, which is consumers prefer to buy online. A lot of them, including myself. I buy a lot of stuff online, and I don't think I'm unique in that respect. So it's really an undesirable industry, and it's an undesirable space for me. Other investors might be comfortable with it, and more power to you. If you make money at it, good for you. But the 5-year chart says that it's not a stock that's going to double in value. One of the goals that I have is buying stocks that are going to double in value over 5 years. This one certainly didn't over the past 5 years. Now, past performance is not indicative of future performance, but let's take a look at the 1 year. It's down 13%. So if you drop your price by 13% stock price, it kind of mitigates, neutralizes that dividend, right? So it's in one pocket, out the other, so to speak. And you have to pay taxes on that dividend. So let's look at their revenue. So is their revenue growing or is it contracting? It's contracting. Over the last 2.5 years, it has contracted. So, and if you look at the last 5 years, they've had negative growth in 4 out of 5 years. They had positive growth in 22. Again, that all that stimulus money that was going out, consumers had checks, and I'm gonna go to Kohl's and buy some new clothes and some good stuff for my kitchen and my bedroom. Okay, cool. That was the 1 year exception, but that just shows that, hey, there's some forces, unfortunately, really acting against Kohl's. When we look at cash flow, let's see if they cash flow. So they do cash flow, 700 million cash flow. That's very good. So they do cash flow. And do they have a lot of debt? So they have $231 million of cash and total debt of 7.4 billion. 7.4 billion. And their EBITDA is 1.42. So it would take them roughly 5 years to pay off their debt. That's too long. It can't exceed 3, especially in an industry, in a company that's losing revenue. They're getting smaller each year. So their balance sheet is actually unhealthy and risky. So they're in a risky industry, losing revenue, a balance sheet that's riskier. They do generate free cash. If you did a net present value on that cash, you'd probably get above $2 billion in valuation. But in general, it's a complete pass for me. It's not the right industry for me. We have thousands of stocks to pick from. I'd rather pick stocks that are like in industries that are heading up, that keep getting bigger. They keep getting more powerful. They keep getting stronger. Companies that keep getting bigger, stronger, faster, more profitable, higher cash flows. That's what I'm looking for. And if I buy a stock like this, it's going to be a distraction. Why is it in my portfolio? Why am I spending time on Kohl's? It's not in that investing recipe that I want. I want to find more Metas. I want to find more Ubers. Where can I find another Uber? So that's my opinion on Kohl's. Thank you for asking. It's just my opinion, but I think people keep asking for my comments because if anything, it's interesting to hear another investor comment on a company. Thanks for asking. And you asked a combo question, which was, where do you think consumer discretionary is going to go from here? And I think that given that we're going to go into a recession, right? Or setting the expectation we're going into recession, it should be bad for consumer discretionary. Now, consumer discretionary is like such a broad uh, array of company types. Amazon's consumer discretionary. Nike's in there. I mean, you have a lot of like companies of different types, and there's opportunities in there for me, and I can go in there and pick certain companies that I really want to be an owner in and buy them. But generally, as overall space, I think it's not going to do well if you have a recession. You have, I think I showed that you have the consumer is really beginning to feel the weight of all that debt they took on. So all those factors are going to go against consumer discretionary. So that'd be my comment there. All right, Sebastian wanted to see if I could look at African stocks, and super interesting topic. I mean, I didn't get up today and say, hey, I'm going to look at African stocks, but here I am. Super cool. So we want to look at Zenith Bank, right? And I don't know if I'm going to have access to it. So there it is. Cool. Okay. So Zenith Bank is in Nigeria. They have a high dividend rate. So this bank's done really well, up 111%. So the market cap is 1.9 trillion, but what currency are we dealing with here? So we're dealing in this currency. So NGN, and I could, on another screen over here, I'm going to look up the conversion rate. So it's 0.00061 to $1. So this is probably around the 60. I don't know what it is. So let me do a quick conversion. And if we looked at $1 billion, it amounts to 6 billion in market cap. So this is about a 6.8 billion market cap company. And other numbers will be, a fraction of what we're going to look at, but we can look at percentages, and their growth has been really high. So that's probably why the stock's really working. Now, I don't know about the Nigerian economy. I don't know about the banking system there. There's a lot of things that I just don't know. I wouldn't be able to invest anytime soon, but it would be an area of, hey, let me keep an eye on it. And I appreciate you bringing it up. You have more, history in investing there. It'd be cool if you continue to comment and provide those comments on live streams so we can get familiar with stocks in Africa. But growth has been phenomenal. Now, banks, I don't price using free cash flow. I price them using book value. And if they grow their book value, it's representative that the bank's adding value. So I think I get access to book value. So you look at the book value per share. This is very, very good. The book value per share is expanding. That's one of the measures I use when I value a bank. That's a very good measure. And I look at earnings per share. So the book value is expanding. Very good. And it looks like I don't have any analyst information showing what they think, because it is a stock outside the US. Interesting idea. I would have to do a lot of homework on, Nigerian stocks, maybe look at South Africa. I'd have quite a learning curve to climb, but I appreciate you bringing it up. If other investors on the live stream, have invested in Africa with success or failure, I know there's other viewers that are in South Africa that view and comment, but please keep the comments coming. If you've had success, please share the examples. All right, so I think you wanted to look at Schlumberger as well. So let's take a look at Schlumberger. So Schlumberger provides services to the oil industry. So as they want to build, new extraction operations where they pull the oil out of the ground, transportation, everything having to do with oil, the oil complex. And they do these services in the United States as well as abroad. So in the Middle East, where a lot of oil exists, they have services out there, as well as other parts of the world. And we did look at it. It's got a market cap of 58 billion. I think the reduction in oil prices have affected it recently. Over the 5 year, it's done 18%, not very good. The dividend is 2.7%. The company is growing. Look at that. So it's growing nicely. It had a tough time. In 2020, they get a complete pass. Oil prices collapsed then because of COVID. But I'm impressed with their growth in 22 and trailing 12 months. Let me look at the quarterly. Looks good. So now cash flow, how do they do with cash flow? So cash flow is really good. It has gone up over time. You could see that now they're about a $4 billion cash flow company. Now their industry, I would multiply that times 10, maybe 15, which would lead me to conclude that they are either priced at a premium, a slight premium, or they're priced fairly. So there's no real great discount there, given the existing free cash flows they produce. And keep in mind, even if oil prices rose a lot, Schlumberger doesn't benefit from that because they're not the ones owning the oil. The oil company does. They're providing services and they bill those at a particular defined rate that's not based on oil. So this one was a pass when we looked at it a couple weeks ago. We actually looked at Pump at the same time. And Pump is similar. They provide services for a very specific use case, which is the fracking industry. You can see that the last 5 years, it hasn't done all that great. Over the past year, it's down. But, past performance is not indicative of future performance. Is there an opportunity here? The PE is low. It's a tiny company, $761 million. They do more revenue than their market cap has. Some analysts really love this thing. It's discounted by 60%. Now, when we look at, and I'll just jump into the valuation, and I can show it to you and show you where this thing valued. So here's Pump, and their trailing 12 months free cash flow is 149 million. And if I grow that just by 5%, which it could grow much higher, the forecast would be along these lines, and then terminal value being 3%. Now I go with a very high discount rate. Discount rate means I'm going to discount all those cash flows to get to a net present value. It also could be defined as your rate of return, a very nice high rate of return of 12%. I get an intrinsic value of 1.6 billion. Add cash, take away debt, so I get an equity value of 1.5 billion. But the market is pricing the company much lower, to the point where I think it's 96% discounted if I look at cash flows. Earnings per share doesn't get me a very good discount. In fact, it shows a premium. But in general, I think this company is discounted. So I've been nibbling at this one, just, nibbling at it $100, $200 at a time. And this one I prefer over Schlumberger because it just values far better. So thanks for asking about Schlumberger. Mr. N. Kiter. And let me catch up on some other ones. So Shadow Guy. So I like that stock. I like that stock analysis has global stocks exchanges now. Yeah, it is pretty cool to see outside, my area of kind of expertise, which is the US, and kind of see other regions. Anyone ever look at Stadler Rail? I've wanted to get into rails. Like I follow UNP, and like rails most definitely are monopoly-like operations. And I believe they, like baseball, the government has said, hey, monopolies in rail are okay because we need them to invest that kind of infrastructure and then keep them operating. So that you only have like one rail line in a particular region. Let's take a look at the one you're looking at. So S-Rail. And I think this is the one. So Stadler Rail, through its subsidiaries, engages in the manufacture and sale of trains in Switzerland, Germany, Austria, Western and Eastern Europe, the Americas, CIS countries internationally. So these guys manufacture the rail infrastructure, rail cars, and so forth. Interesting. What I'd be curious is, so you make them, and man, shipping these things must be really difficult. How do you make 10 rail cars? How do you get them from, I made them here and then I need them to get to over there across the world? So this is the kind of product they're making. And this is becoming more and more popular in the US. Like I live in California, which is way behind the rest of the world when it comes to this type of transportation. And I would like to see us do more because at the end of the day, our highways and freeways are just so congested because everybody drives a car. Well, if a good part of our population got into, mass transit, I think congestion would go down. I think it's pretty convenient to take rail, but we don't have a lot of it here. So you end up having to get in your car. It'd be nice for us to build more. So that's what they do. Now they manufacture this stuff. So they're not operating a rail line, if I understand the company correctly. And the company is in Switzerland. Their currency is CHF. So CHF. And that's 1 Swiss franc is worth 1.18 US dollars. So it's a currency that's a little more valuable than the US dollar. So when we see this number, we're actually seeing a company that's 3 billion in market cap versus 2.55. They have a dividend. Now be careful with foreign stocks. I have foreign stocks that pay dividends, and those foreign governments charge their tax before I get my dividend. And then I got to pay the US government. It's like, geez, man, multiple governments taking tax, which is not fun, but oh well. They grew a tiny bit in the trailing 12 months, and they do semi-annual. That's typical of Europe. In the first half of 2024, they grew a tiny bit. Second half of 23, they grew a tiny bit, but they did contract quite a bit in the first half of 2023. So growth is slow. Are they profitable? They are profitable. Okay. And do they provide good free cash flow? They're about a $2.55 billion Swiss franc company. This is in Swiss francs. They're doing, wow, their cash flow came down. They were at a pretty good clip, and they probably had to put a lot of money into CapEx or something. So why did it drop so much? So operating cash flow came down substantially. Change in inventory. So when it's negative like this, it means that they have built up inventory. So they probably have a bunch of rail cars and rail systems that they manufactured, and they're sitting there waiting to be delivered to customers. Now, I doubt that they inventory this stuff like, oh yeah, we got, 20 trains in stock. I think it's driven by customers order this, and there's an agreed to delivery time schedule. Like, okay, we'll deliver it in a year, 2 years. And they have that type of forecast that they build toward a forecast versus they don't build the stock. They build to a forecast. So they're probably just sitting on that inventory, and that's waiting to be delivered to the customer. And the customer's like, yep, thank you. Deliver it next month, next quarter, and it'll be delivered to the customer. So that's not overly concerning to me. Sometimes if it is a make to stock company, I would be concerned because sometimes that inventory gets written off. Like, oh man, we made too much, like an apparel company. Let's say this sweatshirt. Oh, we made too many of these. We're going to have to write it off and donate it because we can't sell it. Or an electronics product. There's so much innovation there that, they make too much, and then, oh, nobody wants to buy that gadget anymore. So write it off. So it's a concern for some industries, not for this one. I'm not overly concerned. So I'd be probably more inclined to use their more historic average, knowing that, hey, they built up their inventory, and that's why we have a lower free cash flow number. It'll probably catch up in the next year. Having said that, so the free cash flow on average is probably around 500 million. So this company would be discounted if we looked at free cash flows because it's valued at 2.5. But the growth is a little bit of a concern. They're kind of a slow grower. So let me look at the balance sheet just to make sure they don't have too much debt. Cash is 807 Swiss francs. Total debt is, not a lot of debt. Almost enough. They almost have enough cash to pay off all debt. So if you're very familiar with this company and feel like, hey, this is a really well-operated company, like in my mind, I believe Nike is a very valuable company. I have that comfort level. It's a U.S. company. I've studied their history. I've known of the company. Very comfortable. I don't have that comfort level, nowhere near that I do with Stadler. But if you do have access to the company, understand the company, maybe you do have that comfort level, or that the company is good or bad, right? For me, it's not the case. So I'd have to pass just because it's too wide of a bridge, of gap for me to cover. And but fundamentally, the cash flows support a higher value for this stock. If everything else checks off, because I know Shadow Guy, you're in Switzerland. This seems pretty solid, but you'd have to make your decision on that, and you'd have to get really comfortable around the company and be comfortable around what's the deal with growth. Like, why are they not growing? And are the prospects for growth better for the next couple of years? Now, we are going into recession, right? And I think the recession in Europe is also going to begin to happen. Is that going to slow infrastructure projects down that include rail systems? Maybe. Not a big, item to take into a decision on a stock, because if you're getting a stock at a good discount, you're getting the stock at a good discount. This one's been kind of beaten down quite a bit. So anyway, those are my comments on Stadler. Good luck with that one. All right. So let me keep rolling here. And I think I left off with Enkiter. So Enkiter, I'm going to get to you. And am I still into Prudential? I'm going to answer that question. But first, let me take a look at the stock market. We've been open for roughly 20 minutes. And we're in the green. Look at the Russell. Whoa, we were in the green for a moment. Now we're in the red. What happened? Jeez. Okay, so NASDAQ is in the red. The Russell's still in the green. The Dow, which is 30 companies, very well-known companies, is in the green. The VIX is up. And Bitcoin's down. Meta's down. Pfizer's up. Chevron, that oil price, remember we were talking about that? That's up. So first hour of trading, especially, I watch. Sometimes I do a trade or two just because I go into a day going, hey, I really want to sell this or I really want to do that, and I get it done. But most of the time, I let the market tell me this is what's going on today, and then I know, okay, am I going to be, executing any trades? So we'll see. All right, so that's what's going on in the market. And Kiter, am I still into Pru, which is Prudential? And the answer is no. I did well with Prudential and decided to exit it because I had Allstate, which is a insurance company. Now, they're different insurance companies. Prudential is a case where it really did take on this type of situation where I've known of Prudential for really my whole life because they're a life insurance company and so forth. From an investing perspective, I've been investing in and out of Prudential for 10 years. So I've got to know the company, and they had rough times. Remember when I talked about the Federal Reserve began this drastic, increase of interest rates? Well, that really hurt Prudential, and it hurt a lot of companies that have an interest rate really affect their products and services and insurance products. So that really toppled their valuation a couple of years ago, and I'll show that to you. But I know that the company, for a temporary time, was really unappreciated, really was sold off, and it became a really attractive investment. But it was not like an investment that I want to keep for 10, 20 years. It was something of, hey, let me buy it here, and then I had a plan to exit here. Okay. And that became the reality with this stock, because you could see that, coming out of COVID, everything went down during COVID. It went up nicely, but then the high interest rates I was talking about just really put a downward force on this stock and went down 35% or so. And I started to accumulate shares, and then I got out of the shares. I did well, over the course of about a year, like 40% return. Awesome. I got out of it. I own Allstate, which is an insurance company. And I decided to really concentrate my investment for this sector in this industry into Allstate. So the answer is no, I'm not in it. It's a good company. How much longer is it going to keep going up and to the right? I don't know. I think it values really well. It has really good intrinsic value. I don't think I have a valuation on it. I don't think it's on my watch list. Oh, it is on my watch list. So let's take a quick look at it. It values very well. It's never been like, it hasn't been a decision where, hey, I'm not buying Prudential because it doesn't value. It actually is very highly discounted. If it's a good stock, for a portfolio that needs a good dividend payer that is probably going to go up, here's a pretty good idea. And what do they do from a dividend perspective? They do 4.47. Year to date, it's up 13. So 13.5 plus 4.5 is a pretty good rate of return on a pretty well-known financial services company, $42 billion market cap. Not a bad idea. So I'm out of it for other reasons, but that's my analysis on it. So Tomas, go Ternium. I like Ternium. It's a stock that is still kind of waiting for the economy to sort itself out. It's been kind of going sideways for a while. It's down for the 1 year, But if you buy it at the right times, you could sit on a really nice paying dividend. And this is the kind of stock that I think is going to do this again. And when it does, I may get out of the stock. You see what I'm doing with Ternium here. So Ternium is one of the few materials. It's actually the only materials company I own. I'm down 3% on the stock. I've invested 43,000. It's worth 41,700. And at one time I was up like, I don't know, 40, 50% on it. I think it's going to do it again. I really like their location where their operation is. I think it's going to flourish again, maybe in a year and a half. And I may exit the stock at that point. I'm waiting for that to happen, and then I'll probably get out of Ternium. But I think it is a good company, well operated. They made some good decisions that I think they're going to benefit from. It looks like Tomas Vale, I think, is that the Brazilian oil company? And oil, again, we've been talking about oil. And I looked at, or is it Vale is a materials company? Metals and mining. Yeah, I had it wrong. They do metals and mining similar to Ternium. I believe they cash flow really well. Last time I looked at them, they cash flow very well. And I think they pay a high dividend. Market cap is 47 billion. Yeah, look at that dividend. Wow, really high. And I think part of why dividends for these companies is so high is that the stocks are pretty low priced. If it was priced at $20 per share, it'd be a 6.5, 6.6% dividend. So with the stock price being so low, it really yields a very high dividend. I don't think material prices are going to stay here forever. And the way material prices work, it's interesting. It's not that what's the demand today on that commodity. It's what's expected in a year, in 2 years. And as the demand for the iron, and it looks like they do nickel, copper, as that demand is forecasted to be higher. So as we go into this recession, the forecasters continue to look a year ahead. And once we see that, okay, we're going to go into a recession, then get out in a year or two, the commodity prices will start jumping up. And then that's where Vale and Ternium are really going to start going up in price. So a couple of good ideas there. Again, if you're a long-term investor, you make decisions today that are going to pay off in a year or two. And that's part of the recipe that I use is buy when it's low, and then you're going to see it really go up. Following this type of chart is right now, yeah, nobody likes them. Really, beat up, not doing much. Great, accumulate shares. And then, oh, hey, the economy is going to do a lot better in a year. Boom, stock price goes up. Then you decide, hey, do I want to go ahead and take the gain, or do I want to keep it long term? That would be your decision at that point. So thanks for bringing up Vale. Hawker, booyah! Jim Cramer. All right, so good call on Apple puts. So I'm shorting Apple. What's it doing today? Is it doing anything? And I think I've kind of shared my reasons for it. No growth. It's super expensive. It's a $3.3 trillion company, and they're not growing. It's like, am I totally not getting it? Or are investors just really comfortable? Hey, I know what Apple is, so I'm going to invest in it. And I think that's more of the case. So we'll see where that goes. So, all right, some bond talk. Woohoo! ABB, bond ETF or REIT now for yield. Ooh, man, that's a very good question. And I'm going to answer it with both. I think that I own one REIT, which is CTRE. I would own more, but I own real estate, which does its own thing. So I don't want to be overloaded on REITs because I already own real estates. My real estate's more valuable than all my stocks put together. So I don't want to put more money into it. But if you're looking for a yield, like, hey, I'd like that investment to do 8%, 6%, 7%, right? REITs look pretty darn good. And bond ETFs look good. Individual bonds look good. So I would say own a couple of both or own one of both. I think they could both serve you well. The bond ETF is going to be cleaner. Like, hey, I'm going to do 5%. I'm going to do 6%. The REIT is probably going to be about the same, but it's probably going to have some ups and downs. Like, oh, cool, I'm making a 5% dividend on my REIT, but the price of the stock went up 10%. So I'm actually doing 15. Flip side of that is, hey, great, my REIT is doing 5% dividend rate, but the price of the stock went down 10%. So, I lost net 5% this year. So welcome to stock investing. That's what you play with on the REIT side. The bonds tend to be like, hey, that's the value of the bond. And at the end of the term, it's specified investors will be paid this amount back. So it holds the value quite clearly and more predictably, and your yield is very predictable. That's why the bond market is much larger than the stock market. That's why institutional investors like universities and governments, they invest in bonds because they're like, hey, we're going to need this kind of cash flow for the next 20 years. Put it into bonds. It's very defined and it gets us that type of return. So good question. All right. Oh, what do I think about NIO? So we're talking about the car company, not talking about the actor Keanu Reeves. So NIO has been growing very well. I don't know if they're profitable. Yeah, they've been losing money and not generating free cash flow. So NIO's not in my investing zone. It's not the type of stock I invest in, but let's look at a couple of things and I'll point a couple of things out. Things that I like about NIO, things that I don't like. First, they're not profitable. I don't like that. I would say that China's coming on strong with EVs, and they're going to be a big player in autos, if not dominate in 20 years. Why do I say that? Is if you look at certain categories like the computer equipment that I'm working with, right? It's all made in China. And guess where it was made 40 years ago? It was made in the US. But the advantages that China had in the manufacturing and a lot of the labor cost, lots of advantages that they had. The technology industry moved a lot of its manufacturing capacity, including the iPhone, to China and Asia. And that's where it pretty much has been. The automotive industry is, in a big way already outside the US, right? A lot of the parts get manufactured in China. And then they come here and they get assembled. Well, just keep them in China and assemble the whole car, and not necessarily where it's destined to go to the US, because the US is going to be very protective of its industry of automotive. But what about Latin America, Mexico, Brazil, Argentina, Chile, Peru? Those economies are doing quite well. Even El Salvador is doing really well. Well, they get the choice. They go, okay, American-made Tesla, I pay $40,000, $60,000, $100,000 for a vehicle. Here's a Chinese product that serves the same, purpose. It's 10 grand. It's like very, very affordable. This, the two cars are similar. One's a little bit better. The Tesla's probably better, maybe 20% better. Technology is better. Okay, great. But it's not 4 times better. It's not 10 times better. So when you look at that type of the consumer being, especially in Latin American countries, African countries, countries where there's disposable income is just lower, $10,000 looks pretty darn good. So I think that the Chinese auto companies are probably going to do really, really well. Now, from a stock value perspective, if a company is headquartered in China, operates in China, in the US, in the US stock market, these guys do get traded in the New York Stock Exchange, stocks in China just don't get the same, anywhere near the same valuation as companies if they were headquartered in the US. And that's just a fact. I mean, Baba is so valuable. They're such a good company, but they get priced nowhere near. If they were located in the US, operating in the US, the stock could be worth 4 to 6 times more than it's worth today. So keep that in mind as you invest in NEO. It's going to be, I think the big story looks good for NEO, but I don't know where the stock's going to go. As a US investor, observing other US investors, there's a lot of reluctance to invest in Chinese stocks. I can't tell you every reason why. I could just tell you I've invested in Chinese stocks and the returns have been less than my other stocks, way less, because just investors don't want to invest in Chinese stocks. So keep that in mind. Thanks for asking. All right. So Sebastian, more on Africa. Keep the comments coming on that. Massive population growth. Great. How's their middle class doing? Is it middle class growing? Political stability? Awesome. Awesome. GDP is growing. Love hearing that. And Anderson, yeah, that's who I was thinking of when I said there's somebody in South Africa. And you're in Johannesburg. Very good that you joined, and would love to see your comments on African stocks. Mike, the dividend investor guy. So Schlumberger is at a 52-week low. Could be priced at a discount, definitely. So 40% of my portfolio is in South Africa stocks. And then the rest you play outside. Cool. So Anderson, if you were to say here are the top 3 most valuable, kind of like more recognized, kind of stable stocks in South Africa, if you could put those in the comments, maybe I'll take a peek at one just to get my head around what a good company in South Africa looks like. I'd appreciate that. All right. So we got Schlumberger comments, and then Shadow Guy following up on that train manufacturer. So yeah, so it makes sense that, because I was trying to put my head around, would you actually manufacture like in Europe and then put these big trains on ships and then get them to its destination? So yeah, it makes sense that, hey, maybe the parts and pieces maybe do get casted and manufactured and produced in different parts, and then you bring it together locally where it's going to be used. So that makes sense. And you bring the knowledge of assembling these trains and so forth. Woo, we got some German in the comments. I'm going to need to learn German to keep up with you guys. Thanks for doing that. That's awesome. I've got a 24-year-old son. He's studying a PhD, and he had to take a summer course on German because he's studying a German philosophy, and a lot of the content is going to be in German. So it's been kind of cool to see him learn German. Yeah, so we'll see where TX goes, man. I like the company. I like what they're doing. A big part of why I kept the stock and didn't just sell at a gain was, I just wanted to own the company. I thought it was a good company to own long term. So Hawker Topicus. So Topicus. Topicus Inc. provides vertical market software, vertical market platforms in Europe. Okay. So software company, they're in Canada, but they sell their software in Europe. Okay. And they're an $8 billion company. If they don't have a P, that means they're losing money, have a small dividend. They're growing nicely. And what are we looking at here? And this is in the euro. So good growth. But I think they're losing money. So they're growing. No, they're making money. So why don't they have a PE? So they're making money. Over the counter. Okay, so cash flow wise, they have very strong free cash flow. Balance sheet, cash is 233, total debt. Looks good, looks good. This is a good little company, so they'd probably price at a discount. I'm not familiar with them. I've got a pretty good string of software companies. I've never heard of these guys, but they seem to be doing something of good value because of their growth. Like I did a video on companies that I think are way overpriced, and Palantir was on that list. They're growing roughly at 20% per year, and they're at this massive valuation. These guys are growing almost 20%. They look really good. So good little company here. Good one to look at. It's over the counter. That's worth looking into. I'm good with software companies. I probably have more software companies than I could buy. I'm buying into Adobe. I'm buying into a couple of others. And the software space has kind of been neglected by investors who are really excited about the AI, space where the semiconductor companies are getting a lot of capital. And so are data centers and all related companies. And it's almost like leaving software companies off to the side, which is an opportunity. Again, how am I going to make money? What I buy today is going to make me a lot of money in a year. That might be the software space. This is a neat little company. I'm going to note them and kind of do a little more homework. I would say that I'm reluctant to do over the counter because when you buy over the counter, it's harder to sell your stock if you ever needed to, because there's a reluctance by investors like, over the counter means it's an inferior stock or there's more risk. All right. So it looks like Shadow Guy, you're looking to get into S-Rail. Good luck with that. Hopefully it gets to your buy zone. You make lots of money on that. So Mike, the dividend investor guy, Neo is on my bad list. So let me put that on here. I bet. Yeah. So Neo, I think investors buy into a big story like, the EV market, super high growth. And I get that. But, growth for the sake of growth I don't know if it's going to pay off. If the car business is, at the end of the day, is not very profitable. It comes with a lot of risks. And, Neo, I think investors are finding that out. And then Imri Adam, only car with solid state ACCU, only car with swappable. Oh yeah, the whole swappable battery idea. Yeah, I've seen that. All right, so Sebastian, check out the EZAA. Oh, okay, there we go. That'd be a way to play into the South African market is through an ETF. That might be worth doing some homework on. I'm going to put that down as a homework item for myself and check it out. Thanks for the tip. I think that's a good idea because rather than spending all the time and energy figuring out Africa, is kind of like buy a solid ETF, It gives you access to that market, and maybe that does well. I'm going to look at it. I think that's a good idea. All right, so interesting, cool. So you have some good. So Anderson's got a couple good material companies. So let's take a look at. So here we go, South Africa. So this is a $14 billion company. Revenue is $33 billion. Really low PE. Dividend is 3.72. Prices are down, probably because the commodities they produce, the prices are down. Looks good. So this is a mining company, and they also do, I think, some operations in Australia. All right, so that's a good idea. Then you have Sasol, which is oil, and then Anglo American Platinum. Cool. Yeah, good ideas. Because I think on that continent, right, you have a lot of natural resources. Those are good plays in Africa. I'm going to take a look at these. Yeah, thanks, Anderson. Cool. Yeah, it's good to hear, and good to see, the kind of stocks you're into in Africa. And then there's also Van Eek. Okay, very good. Good ideas. Thank you. Cool. Good ideas. So let's check in with the stock market. What is going on, stock market? All right, now we're looking better. The Nasdaq's recovered some of its losses. Russell is still in the green, and then the S&P is slightly in the green. The Dow is still in the green. So that looks good. Crypto, what's crypto doing? Down. Crypto's been kind of like just going sideways for a couple months, not really doing much. Interesting. All right, we'll see how it plays out. I don't think volumes are going to be very high today, tomorrow. Wednesday afternoon, you may see volumes really take off in the afternoon after the Fed talks. And then Thursday, because the employment data is going to be released in the morning. So Thursday is going to be the big day. It's going to be when potentially we're going to see a big sell-off or a big rally. I don't know that there'll be a big rally, but there could be a big sell-off on Thursday and Friday. We'll have to wait for the employment data, and we'll see what the Federal Reserve has to say. All right, cool. Good session. We're off to the races this week. Again, I think it's going to be a little quiet today, tomorrow, and Wednesday afternoons when all the fireworks are going to go off. We'll see how that goes. But thanks for tuning in. I'll be back tomorrow morning. We'll see how the trading day goes. We'll talk again. Thanks for bringing the really good ideas on stocks, especially in the continent of Africa. That was very interesting. Let me wish you all a nice day, afternoon, evening, wherever you're at. And I appreciate you tuning in. Take care.